So why an investor with a long-term horizon will go for bond investing and not equity investing when he knows that over the long term the stock market has given better and outperformed the bond market? Now there are two reasons to it. One is called as a loss aversion. Loss aversion means I will feel very bad if I lose money than the good if I make money. So the degree to which I am feeling bad is more than the happiness I would be getting by making money. That is point number one. And the second is mental accounting. Now the question about mental accounting works this way. Suppose you are coming home after a party and now there is a maid at a home and you have to give her 500 rupees. Now you don't have 500 rupees at home, so you take her in your car, you go to an ATM, withdraw 500 rupees, give her a 500 rupees, and then she goes back home. And you come back home tomorrow morning, you wake up and you see, okay, that 500 rupees one extra that I had with me is already in my jacket. So when you take that 500 rupees, you feel happy. Okay, I have got it. Although the money 500 rupees that you withdrew from an ATM or the one that is in your pocket has both come from your bank account. But the happiness that you get, you feel that it is an extra money that you have got, and then now you play with that money, you go and spend that money, you are too much, you are not thrifty with it. So that is how the human psychology works. And that is also a reason why many a times you as an investor hold on to the stocks which are at a loss, because you can't sell them, because you think that if I sell them then I have booked a loss. So therefore, unless and until I don't sell those stocks, I have not booked a loss. So therefore, I have not lost anything. So that is what happens. Now, there was also a research which was done over a group of two batch of students. In one batch, they were said that, okay, you are given these $30. Now, your catch is if you gamble it and you win, you will get $9 on top of it. So it becomes 39. And if you lose, the $9 will be deducted. So therefore, what is the amount? $21 they will be getting it. So this is the one game. So majority of them chose the option, okay, let us gamble it, because in worst case scenario, we were not having any money, but $21 is the worst case scenario, we will be getting it. To the second batch, they told that either you can just go away with $30 or you can gamble it and you will either get 39 or 21. Here again, they worked in the same manner because they knew that, okay, at worst case scenario, they are going back home $29. So that means they were sure that they are going to back home with any fixed money. This is what happens when you as an investor are looking at investments and go with a PPF over a 10-year horizon with a lower rate of return than equity investments for the same long duration, or because then there comes the behavioral bias in it. So this is actually called as what you say, that mental accounting and the loss aversions, if we may say. This is how the dilemmas of, because then you actually think in boxes, you think in accounts. That is how the mental accounting works. Thank you so much.